Welcome to the Metals Investor Forum. I'm Jay Taylor. I'll be heading up this block, and then after myself, Eric Coffin, Joe Masmader, and Greg McCoach newsletter writers will be taking the show over from after my time here. And there's a lot of great companies presenting here today, so I hope that you'll stick around for the whole show if possible. Anyway, I'd like to start out by just reminding you that I write a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and I host a radio show called Turning Hard Times into Good Times, and it airs every Tuesday at 3 o'clock New York time, and you can catch it by podcast on the following day at Jay Taylor Media or at my YouTube site. I've titled today's my presentation, "The Dollar's Demise in 2021 and What That Means for Our Investments." And I'd like to start out by showing this slide because the fourth turning, a very important book, I think, historical insights of how societies run through cycles, and they have very profound impacts on the way we live our lives and the way we invest our money. Things change very dramatically every 80 or 100 years, and I think that America right now and the Western world probably is in one of those very substantial changes. And we've, of course, seen the riots during the summers and the events that took place last week in Washington, I think is all part of the evidence of a major fourth turning that's underway in America right now. I really like to pay a lot of attention to successful investors, and Ray Dalio being the largest hedge fund manager, I think, on the face of the earth. He's done his own study of history, and I know he's very much a believer in the fourth turning, but just to quote Ray Dalio and what makes for a sustainable and successful society, one timeless and universal truth that I saw went back as far as I studied history, since before the Confucius around 500 BC, is that societies that draw on the widest range of people and give them responsibilities based on their merits rather than privileges are the most sustainably successful, because they find the best talent to do their jobs well, they have diversity of perspectives, and they are perceived as the most fair, which fosters social stability. Now, I would suggest to you that a lot of those attributes are things that we're starting to lose in America. I believe no longer are we such a country of a meritocracy, because equality of outcomes seems to be more important, determined by race, sex, sexual orientation, and other issues rather than the merits of what people do, regardless of those differences in their personalities. And I would say that we are also facing censorship in the United States like we've never seen before. And I would suggest that even in terms of science, sometimes science is affected by the political class. In other words, what is acceptable to the political class is allowed to be spoken, what is not is shut off. But what I'll focus on mostly here in my talk is the petrodollar entropy. I think the system that we have in place now has its own built-in demise, and that, I think, is something we need to be mindful of. The dollar could be in some significant trouble as we progress through this year. Dalio also presented this idea of ascending and descending powers, and you can see the attributes of an ascending power, moving up prosperity. He's got China on the left there as an ascending power. And then when we reach a level of debt, things start to deteriorate, and he's putting the United States in, certainly accurately, printing money. We're doing it in spades, trillions upon trillions of dollars created out of nothing. And it is no doubt that it is leading to a lot of difficulties in our country, followed then, unfortunately, by revolutions and wars. Go through the cycle, and then you start a new system again. Now, so, we could be in, I think, for some very tumultuous times. We're certainly seeing this year get off to that kind of a start, just as last year was. In terms of, I'm really talking about big picture, longer term things now. I'll get to the shorter term, more immediate market considerations. But these are just some metrics that show where the United States is compared to what it had been in 1969 versus 2020. You'll see the debt, U.S. federal debt, up 75 times total debt up 53 times, US GDP up 20 times, US debt to GDP fourfold. Now China's GDP going from 80 billion to 14 trillion, 175 times. And you see the stock market's up, gold up 53 times, gold versus the dollar, or the dollar down 98% against gold. And you see the Swiss franc, dollar down versus Swiss franc as well. But turning to the more immediate market picture right now, I think we really saw a major turning point back in March 22nd, 23rd, when our Federal Reserve Chairman gave his Mario Draghi speech, whatever it takes. Clearly, they threw in the towel in terms of trying to normalize the balance sheet, realized because the stock market started to tank, as you'll recall back at that time, and they started throwing caution to the wind and just pumping money, trillions upon trillions into the system, and that has had a very substantial impact on commodity prices. As you'll see, copper stock prices have continued to rise too because interest rates have been forced lower, and gold as well has done well, but not as well as a lot of the commodities, and certainly silver is outperforming gold now. This is just another chart table showing all of the different commodities that have risen dramatically against the dollar. The dollar is certainly losing its purchasing power. The trade-weighted dollar index shows dollar down 11.9%. Pound sterling, you see all those other currencies have gained, the major currencies versus the United States. M1 was up 55.9% since March, but there was a 2-week period in December when M1 was up 14%. That would annualize out to 360% rise in M1. Interestingly enough, the Fed decided it was going to start reporting M1 in a way so that it didn't shoot up so straight, so that it didn't go exponential as it appears to be doing. But a lot of that M1 came out of M2, showing a preference for people to now move towards more liquid assets. And banks aren't lending, and a lot of those assets go into the M2 category. So the relative move to M1, I think, really is very significant as people are looking to get liquid and not really showing confidence in holding long-term assets. Certainly the headline grabber is Bitcoin, and Bitcoin, of course, it's interesting because Bitcoin is now being championed by a lot of the mainstream, so it's very interesting. But the slide I'm showing you here is that slide I was just talking about, M1, that grew so exponentially. This is M1 before the Fed decided to report it differently. This is a slide taken from Alistair McLeod. Actually, it was presented by the Fed. So we can see this almost exponential straight up growth of money. This is a slide that shows non-M1, M2. So M2 includes M1, but when you take away M1 out of M2, you see what's happened. M2 has fallen sharply towards the end of last year. Now, looking again at the bigger picture story, Triffs Dilemma, Robert Triffin, a Belgian economist, he noted the monetary policy dilemma the US was facing in owning the dominant global currency. He noted that if the United States stopped running balance of payments deficits, the international community would lose its largest source of additions to reserves. The resulting shortage of liquidity could pull the world economy into a contractionary spiral, leading to instability. On the other hand, if the US deficits continued, a steady stream of dollars would continue to fuel the world's economic growth. However, excessive US deficits would erode confidence in the value of the dollar. Without confidence in the dollar, it would no longer be acceptable as the world's reserve currency. The fixed exchange rate system could break down, leading to instability. Well, that was written in 1960, in the early 60s anyway. That was what was known as Triffs Dilemma. So the solution, President Nixon and Kissinger and the administration decided that the petrodollar would be a way that we could have our cake and eat it too, it seemed. But there's a major problem with the petrodollar flaw. It is a petrodollar problem that we're seeing now with this massive trade deficit that has been just not only massive, but chronic and getting worse all the time. During the gold standard, we had a fixed rate system. it was self-cleansing, and so you never ran these massive balances of trade. If you ran a deficit, then you had to tighten your monetary system, and then you started with that discipline. You would start exporting and importing less. You'd export more, import less. So it was a balanced system. But when we went on the petrodollar system, it allowed it essentially allowed the United States, well, with the use of the military force, to force other countries to use dollars to buy oil. That in sync with, of course, with Saudi Arabia, and the arrangement to keep the people in power in Saudi Arabia was the arrangement that Kissinger made. And so OPEC, becoming the power that it was able to essentially tell everybody around the world they had to use dollars to buy not only oil, but virtually almost everything. So that has then, and in order for this petrodollar system to work, the U.S. had to run these huge trade deficits. And so we got rid of the higher paying jobs in the Midwest, the manufacturing jobs, the mining jobs, and so forth. We exported the manufacturing jobs overseas, and we ran these huge trade deficits, which was also necessary to ensure that there was a huge amount of dollar liquidity around the world to own the world's reserve currency. And so we've been able to keep the global economy expanding under this system for quite some time. But China, earning all those dollars, rather than taking those dollars and building a military to go against the United States, they just simply quietly went about their business buying up assets around the world. And so you can see the influence that China has. From the year 2000, the United States was still a dominant exporting nation, but by 2019, that had changed dramatically. So you see in Africa, only about 2 countries there that that the U.S. has exporting influence on. So it's largely a Chinese-dominated global picture. It's becoming that way very quickly. So we get back to the idea of who's going to finance this, all these trillions of dollars that the United States is creating, that the Fed is creating out of nothing. And if you look at it from a Chinese or from a foreigner's point of view, why would you buy treasuries? The yields are negative. Real yields, at least, are negative. U.S. treasuries are used to finance the U.S. military that blocks the Chinese sea lanes, or tries to, and keep China from expanding. And there's so many other global opportunities the Chinese have realized, and they've taken those dollars rather than buy treasuries, and have gone around the world and have bought up influence and assets around the world. So if you really look at it from a foreigner's point of view, why would you not continue to dishoard dollars? Rates are rising. The interest rates are now rising. I'll get to that in a moment. They're rising, leading the dollar. That is, rates are rising, leading to dollar-denominated losses. So if you're a foreigner and you own treasuries and the rates go up, your bonds are going down, and the dollar's purchasing power is falling, as I just showed, and as you can see in this slide that I showed earlier. The dollar is losing value against all the other major currencies. And countries that are viewed as hostile to the United States, China now pays for Russian exports in euro dollars more than in euros rather than in dollars. And this is from Bloomberg. Brothers in arms, India agreed to ditch the dollar for its huge defense deals with Russia. So you see, all these are major changes that are taking place, I think, very much in sync with the fourth turning. And here's the thing, Alistair MacLeod pointed this out in a recent essay that he wrote. Foreigners, the treasuries have started to rise. Treasury rates, 10-year treasury has started to rise despite continued money being pumped into the U.S. system. And foreigners own so much. They still own so much of our U.S. dollar securities. So they're not interested in buying treasuries. They're using them for other things. But as I just said, why would they want to? What would it be in their interest to buy U.S. treasuries? Now, the thing that Alistair pointed out was that we've got the golden cross here for interest rates. And it looks like we could be on to a new bull market for interest rates, a bear market, of course, for treasuries. Yesterday, I think a couple of days ago, the Fed suggested that it would stop, that it would start tapering, and rates did come down a bit. But then yesterday, when Joe Biden announced a $2 trillion stimulus package, I think the 10-year treasuries shot up about 5 basis points in a New York minute. I don't know why that isn't likely to continue happening, given the fact that here you see what's happening. The Fed, since 2000, basically, and into 2000, has purchased all of the new treasury debt. Who else is going to buy it? That's the problem. Lisa Abramowitz, who's a reporter at Bloomberg, I follow her on Twitter, she said a big argument to buy US stocks now at such high valuations is their value relative to extraordinarily low bond yields. But as treasury yields rise, that advantage gets diminished. Right now, the earnings yield on the S&P 500 is the lowest versus 10-year treasuries since 2018. In other words, the stock market, the equity market, at some point could be in trouble here. But the Fed is going to probably try to, to try to put a lid on the rates to try to keep things together. But the pressures, of course, are against that because of the massive borrowing that the U.S. is doing. So just looking at what we're, the system that we're facing now, foreigners are no longer buying U.S. treasuries in large quantities as they have in the past. At the same time, the U.S. Treasury borrowing needs are rising exponentially. And as I just noted, the 10-year Treasury looks poised for a new bull market. Normally, higher rates would lead to a stronger dollar, but given exponential rate of U.S. borrowing needs, the Fed is also printing dollars exponentially to suppress rates in order to retain U.S. Treasury market solvency. I mean, when you think about the trillions upon trillions of dollars of 1% interest rates puts a huge amount of burden on the U.S. Treasury. So they're trying to not only to allow the U.S. to finance itself, but to avoid some sort of a 2008, 2009 disaster again. So with the dollar's demise now obvious, foreigners are exiting even more aggressively, requiring the Fed to respond in kind, leading to still more foreign selling of dollars, a vicious cycle, I believe, that is taking the dollar down, I'm afraid. So just summing up the macro picture, post-COVID, we already had some issues. The September 2019, the repo market spiked to 10%, largely because foreigners were staying away and banks were up against the amount that they could buy. They had to keep a certain amount of cash. And so we saw this 10% spike in the repo market, and that's when the Fed really ran into the market to keep things from crashing back in September of 2019. Then comes along COVID, which really shuts down things and throws us into a depression. Revenues going into the U.S. government dramatically declined. Of course, money being put out is expanding, so the deficit is growing very dramatically. Despite money creation, increased exit by foreigners, they're running away. I just mentioned the golden cross. Looks like we're in a bull market for interest rates, bear market for bonds and treasuries. So, but if you put yourself in the shoes of foreigners, there's just no reason that I can see why they would want dollar-denominated assets. So it seems to me that a vicious cycle is underway. I expect when Eric follows me, he'll probably put your mind to rest at he's somewhat from what I'm saying. Eric is not such an alarmist as yours truly seems to be, but this is the way I see it. I think that foreigners are buying, they're just not buying massive amounts of quantities. For decades, we got away in the United States with living beyond our means thanks to the kindness of strangers. Well, sure, they were selling us more than we were selling them. They took our dollars, and now they don't need us anymore. They're basically expanding their own empire. So an exit from the dollar to Bitcoin, gold, silver, commodities in general, I think is just starting as a hyperinflated M1 appears to be underway, leading the dollar and all fiat currencies, I'm afraid, to a downward spiral. And that, of course, will lead to the question of what will take the place of the dollar. And that's a topic for another day. It's certainly one that I'll be talking to Alistair McLeod about. I think he's on my show next Tuesday, no doubt. We'll talk about Bitcoin. There's a lot of people think that that's where it should be going. But honestly, I think if you look at the market that has lasted for thousands of years, gold is the one I think that you need to put your trust in more than anything, and silver and commodities and real tangible things that the government can't. Well, they can certainly take it away from you if they pass a law, I suppose, but they can't inflate it away with the monetary system. So you have to be bullish on gold and silver and some of these other assets, I think, commodities in general. And I think the question is Bitcoin or gold. I'm betting on gold long term, but that's, as I say, a discussion for another day.